Hello everybody that's watching this video. Today I know I've already made a video on this topic and I'm gonna redo it and try to explain it better because I feel like I didn't really explain it like good enough or simple enough. The last video I made, I'm probably gonna take it down. But all I'm gonna do in this video is explain or define just what an R is, and then give examples on why it matters more than percentage returns. And I feel like a lot of people get this wrong. I see really big YouTubers uh, talk about like what's a realistic percentage return and so forth. And don't get me wrong when I say this, like percentage returns don't do matter to, like, I mean, they tell you what kind of return you had on your investment, right, on your capital. So if I say I had a 20% return, I mean, then I made 20% gain on my account, but it doesn't really explain what kind of risk I had to take to gain that, right? That's kind of the problem with it. So I'm gonna explain why. So first, I'm just gonna define what an R is, or it's also called a unit of risk. So it's just a unit of defined risk. That's what R stands for. A unit of defined risk. And if you know anything about trading or read anything about trading online, you probably stumbled upon that you should control your risk and be aware of risk, right? And when I talk about like define your risk, that means I mean like from your entry, right? This is your entry to your stop loss. That distance should be defined before you take a trade, or that risk, sorry, that and distance as well. But that risk, if that's a dollar value, a dollar sign or whatever, or a percentage of your capital, it don't really matter, but as long as it's defined, so what you're willing to lose on a trade, right? And that could be $100, $250. It could be 1% of your capital, 2% of your capital, or 3% of your capital. It don't really matter, but you should always define that before you take a trade, and when you defined it, you should stick with it, right? Uh, so let's say you define like 1 hour is $100 or something. So then you know that 1 hour is equals to $100, right? Or another guy maybe defines his R as 1 hour equals 2% of his capital, right? Uh, let's do this and then 2% of his capital. So let's say if this is trader A and this is trader B, right? So trader B made 10 hour and trader A also made 10 hour at the end of the month. Then you know that this guy made $1,000 and this guy made 20% return on his investment, right? Okay, so now we got that out of the way. I'm actually gonna explain why it matters more than percentage. So let's take two traders. Let's just say trader A and trader B, just to make this simple. And let's say trader A made 20% return, right? At the end of the month, he made 20% of his return on his capital. Some people maybe say it's great, some people maybe say it's bad. I don't really care. It doesn't tell me much, right? It's just all that says to me is he made 20% of his money, right? And this guy made 2% at the end of the month. What I've seen and like a lot of YouTubers say and whatever, like big YouTubers, that what I think they get this wrong is they look at this and say this guy is great, he's the best, he's better than this guy, right? He's better than trader B just because he made more percentage. What I'm trying to say is that that doesn't always has to be the case, because if you look at, let's say these are two, like, they predefined risk. So let's say in this case, let's make trader B the better trader, and you can all you need to do is, okay, his predefined risk was, let's say, 0.2% of his capital, right? That means he made 10R. At the end of the month, he made 10 times what he risked. So yeah, and this guy, his 1R equaled about 5% of his capital. That means he made about 4R. So in terms of risk, this guy did a much greater job than this guy, right? Than trader B, because this guy made 10 times of what he defined to lose. I mean, he made 10 times of what he risked, and this guy made only 4 times what he risked, but he still made bigger percentage returns, right? And I could make the exact same example, but the two traders are equally as good. So let's say they made the exact same percentage, and they made the exact same R, right? So this guy at the end of the month made 10R, and this guy at the end of the month also made 10R. That means trader A had a predefined risk of 2% of his capital, right? 1R equaled 2%. So let me just draw that up real quick. 1R equals 2% of his capital. That, and if he made 10R, that means he made 20% gain on his capital. And trader B, he also made 10R, but he made 2% gain on his capital, right? That means he's 1R for him is 0.2% of his capital, right? But in terms of risk, these guys did the exact same, right? But it just comes out that it was a different percentage on their account, right? So that's what I see a lot of people get wrong. They don't really they just look at the percentage and don't understand that somebody with a lower percentage can do far better than a guy with higher percentage, and vice versa, right? And a guy with a big percentage can do a lot better than a guy with low percentage. And I mean, two guys that have made literally the exact same percentage of at the end of the month can do, I mean, one of them can outperform the other one by a lot in terms of risk, right? So that's what I just wanted to go over, because I see a lot of people talk about realistic percentage returns, which really isn't that relevant. It's not really relevant. I would say a more like relevant would be how many units of risk can you gain in a year, or whatever, a month. And my like, if you're doing more than 40R a year, I would say you're doing good. I mean, 40R, you could improve, right? But if you're doing 40R plus, you're doing good, I would say. Yeah, it's enough for making trading worthwhile. If you're doing less than this, I would say you just put the money in a index fund or something. But if you make like 10R in a year, that's just too. I would not consider it worthwhile, right? So if you made 40R plus, that's good. And I would say realistically, you could go like an amateur, like a retail okay trader should be able to do 40 to 200 R a year. I mean, 200 R is really good, right? So if you make 200 R, you're doing a really good job. But I mean, you should be able to land around like 80 to 120 R at least if you're doing an okay job, right? So that's my thoughts on that. Yeah, thank you for watching. Hope you learned something.